During our childhood, we often learn that progress means different things to different people. For someone who used to walk to the office, having a bicycle next year represents progress. For another person who used to commute on a bicycle, upgrading to a motorcycle next year is a step forward. And for someone who relied on a motorcycle for their daily commute, having a car for the office the following year signifies progress. This example illustrates how progress varies among individuals. In a similar vein, mutual funds are a financial tool that can help people achieve their various financial goals. Whether you aspire to purchase a new mobile phone within the next 3 years, acquire a car in 6 years, plan for your children's education, or save for retirement over the next 4 decades, there are different mutual fund plans available in the market tailored to each financial objective. Now the question arises, are mutual funds the best choice to meet these financial goals? Let's consider a scenario where you decide not to invest your money in mutual funds. Your financial goal is to buy the latest and most advanced smartphone after 3 years. You visit the market, find that cost of the newest and the best smartphone at that time is approximately 50,000 rupees. Now, you calculate that to afford the smartphone worth 50,000 rupees in 3 years, you need to save nearly 1,600 rupees every month over this period. This means you must set aside this amount separately from your daily expenses and other needs. However, after 3 years, when you return to the market, you discover that the new iPhone's price isn't 50,000 rupees but has risen to 60,000 rupees. Why did this happen? You guessed it right, inflation. The reason behind the increase in the smartphone's price to 60,000 rupees after 3 years is inflation. Assuming that inflation has averaged around 6% over the last 3 years, it has contributed to the rising costs of goods and services, including smartphones. In this scenario, merely saving money without making any investments turns out to be an effective decision, as the value of your savings would have been eroded by inflation. On the other hand, investing in a good mutual fund appears to be a much more promising option. Consider this. During those 3 years, you decided to invest the same 1,400 rupees per month in a reputable mutual fund offering a 12% annual interest rate. At the end of the 3 years, the mutual fund would have provided you with the returns close to 60,000 rupees. With this amount, you would be able to purchase your desired new and high-quality smartphone. Every individual has unique financial goals shaped by their financial needs and requirements. Whether it's buying a house, a spacious car, funding your child's education, or securing a financially stable retirement, your financial goals can be short-term, mid-term, long-term, or a combination of these. These goals dictate how much you need to save and invest. Mutual fund schemes cater to all types of investors, whether you seek higher returns with a higher risk tolerance or prefer good returns with lower risk. In the market, you can find excellent mutual fund plans tailored to every financial goal. In this context, selecting the right mutual funds becomes crucial. If you plan to go on vacation within the next 1 to 2 years, buy new gold jewelry, renovate your house, or purchase an expensive gadget, these are short-term investments. For such purposes, it's advisable to invest in short-term gilt funds or short to medium-term debt funds, which can offer better returns within a few years. Medium-term goals might include buying an expensive car in the next 5 years, moving to a larger apartment, or optimizing tax payments. In this case, you can consider an equity-linked savings scheme, ELSS, or invest in systematic withdrawal plans, SWP, in mutual fund schemes. SWP allows investors to withdraw a fixed portion of their investment at regular intervals. Concerns about your children's education, wedding expenses, retirement planning, or aspiring for financial independence in retirement, these fall under the category of long-term investments. For such purposes, it's wise to invest in equity diversified mutual funds, sector funds, or thematic funds. While these mutual funds may experience short-term fluctuations, they have the potential to yield significantly higher returns in the long run, thanks to the power of compounding. Mutual funds also offer asset allocation funds that mirror the stages of your life journey. When you are young, you can afford to take more risks. So these funds invest in somewhat riskier assets with higher return potential but also higher risk. As you age, these funds gradually shift your investments to more secure and stable options. This approach benefits individuals who may not have an in-depth understanding of mutual funds and prefer to delegate the decision-making to the fund manager while working toward their short-term, medium-term, or long-term financial objectives.